Anand Rathi presents Power of Vision, Stories of Wealth Creators in association with CNBC TV18.
Hello and welcome to the Power of Vision, Stories of Wealth Creators in association with CNBC TV18 presented by Anand Rathi Wealth Limited. We have with us today Feroze Azeez, who's the Deputy CEO Anand Rathi Wealth, and Rajiv Apte, who's a seasoned investor. Thank you, gentlemen, for joining in. Mr. Apte, I'll start with you. 35 to 40 years of investing experience. Tell us what your key learnings have been.
Oh, they have been both good and bad because I started in the early 90s and apparently stock market was booming, and then there was the Harshad Mehta scam, and so obviously I lost a lot of money. So the first learning was no more stock markets. Okay, so it's better to go in for safer things like FDs and mutual funds. But since that day, I have not entered and not dealt with stocks.
Well, Feroze, that's quite unique in terms of a learning, especially in the past couple of years. We've seen a huge boom of direct investment into equities. What is your sense?
It's not being risk averse. It's being risk logical. Right? Risk is the only thing you manage. Returns are not manageable. Returns you can pray for. That's why it's called expected return. So point one is direct equity, buying direct equity brings in standard deviations, which is a measure of risk, which is a very simple measure of risk. Let's not get into the explanation. But it can have 3 times, 4 times the standard deviation than a mutual fund. But in the long run, your returns converge with a mutual fund. It is not logical that a person standalone can beat a 100-member analyst team with a fund manager. And part-time jobs, 2 people with a dealer who is not going to be paid crores, right? Can't beat that systemically. That's point 2. Point 3, I did a study as an organization, looked at 100 clients who do direct equity and saw that if they didn't do direct equity and bought and sold Nifty on those same specific dates, what would be the return? 93% of them underperformed Nifty, but they didn't know of it. Because psychologically, you're not going to look at those stocks which are losing money. You're going to look at winners in your portfolio. But the losers are going to be your laggards for years where you'll be waiting for your price to come back. So when you do this IRR computations, and in my suspicion, that's why brokers don't give IRRs and alphas like mutual funds do. So I personally think that's a mathematical, experiential and mathematical learning that you can have a mutual fund platform. That's why we have 20 lakh crores of equity mutual funds today. And I hope that's the platform which most retail guys use to begin in equity investing.
Anand Rathi presents Power of Vision, Stories of Wealth Creators in association with CNBC TV18.